First, let's examine the difference between continuing and discontinued operations. Continuing operations are the revenue, expenses, and profit or loss generated from the company's ongoing activities.
Discontinued operations are the results of operations of a component of an entity that has either been disposed of or is being held for sale. A component of an entity is anything that can be separated from the business. For a product to be held for sale, it must meet a certain criteria. The company must be actively looking for a buyer for a highly probable sale of a readily available asset, and the sale should be based on the asset's fair market value.
So why do companies even have discontinued operations? Well, they could dispose or sell a product for a number of reasons, but businesses are not allowed to report continuing operations and discontinued operations together. Why? Because investors and creditors shouldn't be misled due to any inaccurate information.
When discontinued operations occur, there are three main events, the first being during mergers because two businesses will probably sell or dispose of assets when merging together. Individual companies may also discontinue product lines or specific stores because they are unpopular or lacking in sales. And finally, components that are no longer of use to the company are also discontinued. The process of reporting these operations is very simple. First, we must recognize what's being discontinued. After classifying it as a discontinued operation, we must report it as one. The first step to this is creating an income statement like usual for your continuing operations. Next, you want to allocate income tax to both operations separately. This is known as intra-period tax allocation. First, you report income tax for your continuing operations, like usual. Then you subtract any income tax on the gains or losses from discontinued operations, and report only that final value. Both ASPE and IFRS use the same process for dealing with these kinds of operations.
Example number 1. Rick Industries decides to cancel its paint products due to a lack of demand. This is a discontinued operation. Rick Industries adds a new product line, increasing the revenue by $22,000. This is a continuing operation. Rick Industries suffers a loss of $75,000 from the sale of their equipment. This is a discontinued operation. Tin Incorporative holds their machine for sale and believes that Rick Industries will buy it. This is a continuing operation. Rick Industries merges with Tin Industries. This is a continuing operation. Rick Industries decides to stop tracking its cash flows for a component of their business but continues to collect interest expense on it. This is a discontinued operation. Now for question number 2, let's assume that David's Boards Company has 3 different types of boards, penny boards, long boards, and the newest edition hoverboards. With the release of hoverboards, the sales of penny boards started to decline. A. What should David do? He should discontinue penny boards and sell more profitable products instead. B. What would be the difference if David owned a public corporation or a small private shop? There is no difference because the rules are the same under IFRS and ASPE. In the next year, the revenue from longboards is $190,000, the revenue from hoverboards is $230,000, and the total operating expenses are $110,000. The loss on discontinuing the penny boards is $60,000. What is the total profit for the year if the company is subject to a 30% income tax rate? If we allocate our income tax expense to continuing operations first and then discontinued operations, we get a final profit of $225,000.
And moving on to reporting examples, let's assume that Mark's Depot reported the following information for the last 2 years. Part A asks us to calculate profit margin for both years. If we apply the profit margin formula, then we get a profit margin of 57% for 2016 and 46% for 2017. As you can see, profit margin dropped over 10% in 2017.
Explain how reporting discontinued operations separately benefits the business and other stakeholders. It allows for accurate analysis of continuing operations. For the final question, assume Anderson's Incorporated sold its printer operations sector at the end of 2017 because it was unprofitable. During the year, the company reported net sales of $238,000, operating expenses of $112,500, a loss on operating the printer division during 2017 of $35,000, and a loss from selling their printer products of $67,950. Assuming the company has a 20% income tax rate, create an income statement to report the operations of Anderson's Incorporated.